Hello, I'm Al Escobar Jr., and welcome to the Delaware Real Estate Show. Before we begin today, I just want to tell you a bit about myself for the millions of people out there who do not know me. I'm a father, husband, business person, and I consider myself an artist. I like to spend time with my family and take my son out to do guy stuff like fishing and dirt biking and golfing. I've been in direct sales since the age of 21 and have worked for myself ever since. Over the years, I've grown more and more interested in real estate, and I sat back and watched the market expand and boom. I finally bought a home, and then a few years later bought another investment property. Soon I had left the company that I'd been with for 15 years to break into the real estate business. I didn't take the traditional route. I worked for the largest real estate marketing company in the world. I was traveling all over the region, from Harrington to Cherry Hill, New Jersey, to over to King of Prussia in Pennsylvania, and every night coming home to Kent County. So I figured if I got my real estate license and worked in Kent and Newcastle County, I could save 7 tanks of gas per month, help more local people, and make a difference not only in my clients' lives, but my family and personal life as well, with the extra time and close proximity to them. So I got my license, and then the market popped. I did well the first 2 years, and then the old tricks stopped working. I still today work the expired and withdrawn list in our MLS like many agents, but the pickings there are slim to none. I work with buyers and sellers, whereas previously I was able to leverage my experience with the real estate marketing background and focus on the sellers. For some crazy reason, a few years back, I got involved with the Lane Carroll Studio and helped set up an audio and video production program. I guess it was my passion for marketing and the art of audio and video that caused me to get involved with it at all. But today the studio is more commonly known as DelawareVideography.com. However, instead of working that business to promote others as I intended when I first became involved, I'm now going to use it to educate myself, the consumer, and anyone else who wishes to listen and stay on top of the industry and the clients that they serve. Just want to say welcome to the first edition here of the Delaware Real Estate Show. We're going to talk a little bit about some different stuff today, talk about what's going on in the finance world. Here with me is Chris Rowe. Chris, tell us a little bit about the company that you represent today.
I work with a company called Prime Lending, which is a subsidiary of Plains Capital Bank. Now, Plains Capital Bank is the largest privately owned bank in Texas. But what they found about 20 or so years ago is they had a small brokerage shop partner up with the bank and open up Prime Lending. And from that, they've expanded to pretty much all 48 states and have developed quite a company. It's a great operation. I'm enjoying working with them. My background is from a broker. I've been working as a mortgage broker.
So it's still a brokerage, but it has a bank behind it?
It is actually a lender, a direct lender. The loan officers that work there are exempt. They're nationally exempt, just like a Bank of America or a Wells Fargo loan officer would be. They don't have to comply, or not comply, but they have to comply with all state and federal regulations, but they don't have to get licensed under the state because the bank carries the license and they operate under that.
That's a big thing going on in the industry right now.
Oh, it absolutely
everybody
is.
Everybody has to get licensed.
But those are all going to convert over. Eventually everybody in the industry is going to have it. We all have the NMLS number. Everybody who writes a loan has to have that number nationally. So we're all nationally registered and licensed.
Okay. So I hear a lot of people talk about that. They say it's impossible to get a loan, but I see deals getting done. Are they all cash deals, or are people actually getting loans out there?
Yeah, well, there's the problem. How many people have cash nowadays? Okay.
Well, in the last several deals that I've done, a lot of them have been cash, and you know what has amazed me is some of them were well over $100,000.
I will say probably right now as a ratio of cash to mortgage, the cash deals are up as a ratio, than we saw 4 or 5 years ago for sure. But no, it's not impossible. I settled on 2 loans yesterday, 2 people buying homes yesterday, one an investor property, one a first-time home buyer. And I'll tell you, in all honesty, I think right there pretty much sums up a lot of what's going on in the industry right now. People are still getting financed. Is the criteria tougher than 4 or 5 years ago? Absolutely.
Sure.
Absolutely.
Sure.
They've tightened up. But they still have to lend money. That's the way mortgage companies and lenders make money, by lending money.
Right.
So that's still going to happen. But going back, if you take a look, yesterday I settled on a first-time home buyer, which is a good portion of the real estate market right now. There's still opportunities for first-time home buyers.
If you don't mind me asking, what was the number on that deal? How much was the sale price for?
Purchase price was $162,500.
Okay. Was that in Newcastle or Kent County?
It was in Newcastle. It was in Newark. No, I take that back. It was in Wilmington, up off of Kirkwood Highway was the location of the property. Single-family detached home, and it was an estate.
Now, was that
that was selling it?
Who was the lender on that one? Was it an FHA loan?
Yes,
it was an FHA. So ultimately, the government is back.
Ultimately, the taxpayer.
Yeah, ultimately the taxpayers lending that one.
Yeah.
So with an FHA, obviously they need a lot less down than they would with a conventional loan.
Sure, 3.5%. Versus 5% with a conventional.
What's the percentage of conventional non-FHA loans versus FHA loans going through right now?
I can't quote you a specific percent, Al. I don't have that data at my fingertips. But that
in your experience, would you say it's
right now? I will say, as far as the people buying homes as a primary residence, it's the FHA loan is definitely the primary financing vehicle on the market today for most folks. And the reason is the qualifying criteria is less than conventional financing for a high.
A lot less money down, too, so that makes a big difference.
3.5%. Also, it permits, the FHA loan permits up to 6% settlement assistance from the seller, whereas conventional, you cannot get that much settlement assistance from the seller until you're putting at least 10% down. So, and
well, what is most conventional loans today? They're going to require that at least that much down, right?
No, 5%.
5%?
Absolutely. I just approved a client, and we're going to go to settlement at the end of the month. He's putting 5% down.
And that's not an FHA loan?
No, it's conventional.
Okay.
Of course, he's got a 770 score. He's got after settlement, he'll have money in reserves, so he has a number of months in reserves. So the risk to that is less to the lender. The other key factor with that, and here's the thing you're going to see, Al, as of April 18th. As of April 18th, we saw FHA, the MI on FHA, go up. Okay, it went from 0.9% of the loan amount.
When you say MI, there's some folks out there who...
I'm sorry. MI is mortgage insurance.
Okay.
What the intent of mortgage insurance is, the misconception that's out there, and many, and it's funny because I run in this from time to time, the misconception is, mortgage insurance, so if I die or get sick, they'll pay my mortgage. No, that's not the type of mortgage insurance I'm talking of. MI, as the industry calls it, is mortgage insurance. You'll also hear it called PMI.
That's what I was going to ask, PMI. Insurance. It sounds more familiar.
FHA, basically has the highest level of mortgage insurance of any program on the market. The mortgage insurance is set up, paid by the borrower on a month-to-month basis, not to protect the borrower, but that insurance premium is paid in the loan to protect the lender from the borrower defaulting. So whatever exposure whatever exposure the lender has at risk will be paid by the borrower in that premium to cover that risk should the borrower default, which means get behind on payments and not pay the loan.
Okay.
But that was a 28% increase we saw in MI on April 18th, PMI on April 18th in FHA.
And that falls into place when the loan is at greater than 80% loan to value? Is that how that works?
On FHA, you have unless you have on an FHA loan, unless you're at 15, a term of 15 or less, okay, and under 80%, you're going to pay the monthly PMI on the loan. FHA is always going to have some type of PMI. It just always is. Conventional loans, what I think you're alluding to, Al, is where when you get it down below 80% on a conventional loan, there's no PMI whatsoever.
Okay.
Yes.
In this market,
absolutely.
That might be a little while, but
well, it can be. We have a market that's operating pretty flat right now. We've seen the double dip come back, and we're pretty much at the bottom of that double dip that we've seen from the bottom that we saw in 2009. So will it go any lower? God only knows. We'll see.
I don't know. With everything that's going on in the market, I think the values will continue to decline, but a lot of the market sectors, it's not all the same. Some market sectors, some values have increased in other parts of the market, but overall you hear the news across the country, it's down. Probably in your state it's down. Probably in your county it's down, but certain neighborhoods are so much different than other neighborhoods. Things are increasing in some places.
Yeah, you would know that, Al, because there are always pockets
Yes.
of neighborhoods and areas that are generally more desirable than others, more sought after by buyers.
Right. And I've had a lot of clients say that in declining, with the market declining, as far as values go, I mean, I heard you say it's kind of flattened off. I think the spring has flattened us off a little bit.
I wouldn't disagree with that.
Right. Well, when the buyers lock into their deals and that those deals settle in the summer, and as that time goes through, the values are probably going to have a declination over the next 12 months overall. And with that, people are often saying to me, why should I buy now? And I'm still encouraging them to buy. I mean, because a lot of people that are sitting there on the fence, they're just kind of sitting on the sidelines watching. I'm encouraging these people to buy. What would you tell them?
I absolutely encourage them to buy. Let's be frank. Anybody that's telling you now's not the time to buy, tell them to show you their crystal ball. Because guess what? Theirs is cracked too, so's mine.
Well, there's a lot of different factors in the market too. I mean, the number one thing I'm looking at, even if the market declines, how long are you planning on being there? If somebody's looking to be somewhere for 3 or 4 years and then have to move, it's probably not the best thing for them to buy in the first place.
True.
If they're there for the long run, it doesn't really matter that much. But the key thing to me about getting somebody to buy now is I think the interest rates might turn around.
Well, the interest rates only have one direction to go.
That's right. So, okay. I mean, the people that are in now at the 4 and 5%, and that that's all great and wonderful. But in history, I've seen interest rates as high as 19 and 20%.
Sure.
And I wasn't in the market or even probably born at that time, or I was a little kid in elementary school. I don't know a lot about that.
I bought my first house in 1983.
Okay.
So I guess I'm showing my age, folks. Anyhow, we bought a tiny little place up in Claymont, Delaware, and I've bought cars that are more expensive than that house. 29.9. We went FHA, and it was 13.75% on the note on an FHA mortgage. So
that sounds ridiculous. A lot of people are cringing right now hearing that. That's what it was.
Young folks haven't experienced that yet. A lot of the young folks that are in the market that are in houses today, and it's funny how you mentioned that, because I remember a year ago when interest rates were up in the high fives and such, they were going like, 5.5? Are you serious? That's high. And I have to chuckle because
people are spoiled, aren't they?
Yeah, we are a spoiled people.
Man.
And taking a look at that, and let's talk rates for a second, because let's just talk the whole market. Here's my philosophy. Right now, we have approximately 1.5 billion in value of foreclosed homes sitting out in the market in this country. 1.5 billion. Okay. Now to realtors, that's like 900 million in commissions that are out there to get. But if we want to take a look, as we're talking about the flatness of the market, whether we're going to see appreciation in the future or not, is it going to remain flat? One thing I think, and this is my philosophy, and folks, you can take it or leave it as you wish, but until we get these foreclosed properties through the system, through the market,
there's not going to be any recovery.
No. So if you're a realtor and you're listening to this, I urge you to try. I know you can't steer clients or anything like that, but show them some of those foreclosed properties, because you, in many cases, and Al, I think you'd agree with this, you're getting houses for 60, 70, 80 cents on the dollar of what the market value would be were it to be a regular resale. And I'm not saying this out there to say,
or even cheaper than that. Yeah,
in many cases, you're right. But until, these are deals out there. Yeah, so the house has, a little bit of, it has some issues. You know what? If I'm buying a house, I'll give you, for instance, I have a young man buying his first house over in Maryland. This property sold for $310,000 in March of 2007. He's buying it for $135,000. Okay, this is a 3,200 square foot house, relatively new. The house is only 10 years old. Okay, so he doesn't really care if there's a few dents and dings or anything like that, because look at what he's getting for the dollar.
Is he going to live there? Is that going to be his house?
That's his house.
Well, that's a great buy for somebody like him. And there's a lot of buys like that in the market.
And it's a Fannie Mae foreclosure.
Now that was one that wasn't in horrible condition. I'm assuming that was in.
It needs a refrigerator. It needs a stove.
Those are appliances, but I mean, it's not full of mold or anything like that.
No. Well, the water's turned off. No, it has no mold. It's missing a few faucets and such, which 30-40 bucks, you can get a decent faucet to put in the kitchen or whatever you want.
Well, the bottom line is that there's a lot of bank-owned properties in the market. Most are in less than desirable condition, and the bottom line is I'd like to talk to Chris a little bit about seeing if there's any kind of mortgages available for those properties when we come back here in a minute. All right, folks. Well, it's time to plug some of the folks who support this show, DelawareVideography.com. Please visit them for all your video needs, virtual tours for realtors, and video for everyone. YouSellDelaware.com. If you want to sell real estate on your own, don't do it without a professional. That's the letter U, SELLDE.com. Also, RichardHBailey.com. Fine art for everyone. Please visit RichardHBailey.com. It's a new age of entertainment and information out there, and it's all for free. Marshcast.com and Smodcast.com. Today we're here with Chris Rowe, who is with Prime Lending, and his website is mortgageformyhome.com. I just went through a little stint of selling bank-owned properties, and I learned a lot. Like, there's a lot of bank-owned properties out there. There's a lot of properties on the market, and they're sitting there. They seem to be undesirable to most folks because of the condition that they're in. What I'm noticing is folks will miss a payment or two for whatever reason. They just bail on the house, and then it ends up being 18 months or 24 months before, myself as the realtor, I'm usually the next guy through the door. And by that time, the house is set for 18 or 24 months without air conditioning, heat, any winterization, anything like that. Pipes are busted. Sometimes the copper pipes are stowed out. The HVAC system's gone. A lot of times when the house has been vacant for more than 6 months, there's mold. There's a big mold issue.
I've seen that happen on a number of houses that I was working on with my buyers to get out. You're absolutely correct.
I would get estimates on these properties, and the estimates would be really high to get that stuff taken care of. And what I found was when I'd go to the bank and say, look, normally this house would bring, say, $70,000, $80,000 in a rough condition, but with this mold and all this other stuff that's going in, it's turning these buyers away. Here's what it would cost to get it fixed. I've talked to a few contractors and investors, and based on what they're telling me, here's what they're willing to pay versus what an end user might pay, but this mold and scaring all them off. So they've been blowing them out really cheap. So I know that there's opportunity out there for end users as well as investors and contractors and builders, and that's a good segment of our market right now. But are there any mortgage or loan programs available for those type of properties?
Sure, absolutely, Al, there are. For the person who's buying a primary residence, generally many of us have heard of a 203K, which is an FHA rehab program. That's out there, absolutely.
Now, how does that work? Because I've heard of it a million times. I've never used it. I've had a few people apply and not get approved for it. Mm-hmm. So I've never actually got to walk through that process. So what are the requirements for the house?
Well, the requirements for the house is basically for a standard full 203K. They will lend up to 35% of the as improved value, which means for you folks, what that means is let's say the property is worth $200,000. So they will lend as much as $70,000 towards the renovation of that property if the completed value of that property is $200,000. If it's $100,000, then they would lend up to $35,000. So that's basically some of the limitations. The other limitations or the other requirements, should I say, for somebody borrowing is a 640 credit score. You're going to have the 3.5% down. Now let's talk about that. FHA will lend to the combined value of the purchase price plus the renovation costs. Now, those renovation costs have to be.
So it doesn't matter what the appraised value after the fact would be.
Well, it does, and the appraiser will do a subject to completion or an as improved value appraisal.
Okay.
And in that appraisal, the appraiser is going to cite the items that need to be repaired to bring that property up to specifications that that the lender will lend against. So in the body of that appraisal, it's going to be determined what has to be done.
Okay.
Okay. So the deal has to work. I mean, the numbers have to work for the deal to work as well. But what they will do is they will lend, FHA will lend to 96.5% of the combined value. Let's just do a real simple math calculation. If the sale price of the property is $75,000 and the renovation costs are $25,000, the sale price plus renovation costs equal $100,000. FHA will then lend to $96,500 for the purchase and rehab of that property.
Very good. So you need a 640 credit score and 4% down plus your closing costs, and you can get it done.
Correct. And closing costs can be funded by the seller, negotiated as well. So
why am I having such difficulty getting these things through? I guess it's just there's a lot of buyers out there.
The 203K program is not similar to a regular purchase money mortgage. There's a lot more work involved. There's a lot more detail. Now, the example I just gave to you in the 75-25, Al, that one would be a 203K streamlined. We wouldn't need to get as many parties involved with that transaction. You wouldn't need the HUD counselor and such involved with that like you would with a full 203K. But you still have to get a licensed and insured contractor, which will be approved by the lender. You still have to go in there. He's got to break out an itemization of the items that are going to be repaired, what the cost is with those items. We're going to have to also calculate in soft costs, such as any permits that are needing to be done, any any type of architectural drawing.
So it's just a lot more details involved, and you're basically laying everything out on a table so that everybody knows what's going on, and there's transparency for everybody.
Because of the additional work out, it's going to take longer to go to settlement.
Right.
It just is.
So what are the closing costs on a loan of that type?
Closing costs on a loan of that type are going to run, I'm going to say, probably on the average loan, $600 to $700 more because of additional costs. You're going to have some small additional title costs. Again, you're going to have re-inspection costs by the appraiser as the work gets completed for the draws to be taken by the builder and borrower. So once the level of work is completed, we get a call. I call the appraiser. Appraiser goes out, does the inspection, and say, yes, I concur that this level of work, everything that was on the list, has been completed up to this date. Release the check.
Very good. So what's a typical time frame for contract to closing on final? Because there's several payouts, I imagine, throughout the process.
Well, we settle the loan. We go to settlement on the property, and then generally it takes anywhere from 60 to 90 days. Is usually what they permit for a standard 203K. Depending upon the work that has to be done, some of that work could possibly be seasonally related, like if a roof has to be repaired.
Right.
If we're in the middle of winter, chances are we're going to defer that till later. Okay, for that to be done, we may defer that until spring or when it's more seasonally.
So once you got your approvals and a plan together, then they make the loan.
Generally, you're looking at 45 to 60 days to settle the loan.
Okay.
If all parties are working together,
right,
and the real estate agent is involved in this too. What I do on one of these is before we go to application, I get all parties together and we sit down and say, here's what needs to be done. The contractor, the realtor, the client. I get everybody together with me, and we basically do step by step through the process of what's going to happen to make sure everybody's on board. Because the last thing you want in any real estate transaction now is what? Surprises.
Yeah, and somebody's not pulling their weight or something doesn't happen and everything falls apart.
Exactly, yeah.
So it's 60 days, and then it's based on, the time frame to get all the work done is based on really the weather then at that point. But like 60 to 90 days is what the bank normally will allow for that.
Yes.
So 120 to 180 days. So it's going to take 6 months usually from soup to nuts with this program. But that's really not bad though, because I've seen properties sell for $20,000, $30,000, $40,000, $50,000 out there that anybody would have bought. So the bottom line is, when I'm talking about these lower end properties, what's the minimum loan on a 203K?
The 203K, the minimum amount that they will loan is, it's got to be over $5,000. What I mean by that
$5,000.
Wait. I don't mean for acquisition. I mean on renovation costs.
Okay.
So
well, that's pretty easy. I mean, carpet and paint and maybe a window, and you're there.
Yes, absolutely. But again, sometimes it's not $5,000, and maybe it's $3,500, but it's a critical item. Let's say let's say the refrigerator or the stove is shot, or the dishwasher doesn't work. I mean, you're talking about something, a combination of those things, or you have a plumbing issue.
Okay, well, like a lot of people out there, my wheels get turning when I hear this stuff. So I'm thinking right now, let's say I find a property for $30,000, and what's the minimum that they'll lend? Like $50,000 or $60,000, something like that. So I find something under that. Right, I understand that, but from the consumer's point of view, there's a lot of money in it, because if I can get it for $30,000 and be in at 40, and now it's worth 80.
Yeah, but it has to be mutually profitable.
Exactly. Okay. I mean, but that's this is what a consumer is going to think. Okay, so Chris, you don't want to. They can't make me the loan because it's only a $40,000 deal. Can I do an addition to that house because I have a bigger family and make this a $70,000 program? And is that something that could be, or is this program strictly for repairs?
This is a rehab. This is not a renovation or addition program. It's for rehabilitation.
Rehabbing a property that is in, so you can't do additions or.
No. The other thing about 203Ks, and here's one of the major questions people will ask. Well, I can save money. Here, they'll come to me and I'll get this sometimes from agents, because many agents don't know the 203K program either, and they'll say, well, this guy's a contractor and he wants to do a lot of the work himself. Well, that's not going to happen with a 203K or even a Fannie Mae Home Styles renovation program. You cannot do your own renovation. You can't. Okay? They want a licensed, insured, bonded contractor to do that work.
So even if a guy's a licensed, insured, bonded contractor, he cannot do his own work?
That is correct.
They just won't let it fly?
That's correct.
Okay.
It's non-arm's length transaction, or whatever you want to call it. There's too much that can be hidden in the cost, per se, if you understand what I mean.
I got you.
Yes, they don't trust the borrower is what I'm saying.
Okay, so the 203K program, that's an FHA program. Right. Are there any other programs from any other private lenders out there that you're familiar with, that you work with regularly?
There are two right now. Both are Fannie Mae. One is the Fannie Mae Home Styles, which will lend up to 95% of the combined value of the purchase price plus renovation costs or rehab costs. The other one is specific. Now, both of these also work for investors as well. So there is investor rehab money as well. There didn't used to be up until about a year ago. There was no investor renovation or rehab money. One is the Fannie Mae Home Styles programs, the one I just discussed. The other one is more specific. It's the Fannie Mae Home Path program. Now, the Home Path is Fannie Mae foreclosure specific. They will only do it on the Fannie Mae foreclosed properties that appear on homepath.com. So that's what that renovation program is for.
So, and you said those are more like for investor use?
No, I'm just saying it's available. It's both for owner occupants. It can be a second home. So if you find a place down the beach, they'll finance up to 90% for a second home on rehab. Or for investor, they'll finance up to 75%. And again, when I quote these percentages out, they're loan to value of the combined value of the purchase price plus the renovation cost.
One thing I'm running into with the investors that I've been working with loyally for the last several years is that they are maxed out on the amount of mortgages that they could have. Didn't it just get reduced from 10 to 5 or 10 to 4 or something like that?
What you're going to find, and what is common that's out there, is many mortgage companies are limited to 4 finance properties for a client. That includes your primary residence. Now, it isn't the number of mortgages, because you can have multiple mortgages on a property. It's the number of financed properties. Freddie Mac limits it to 4, period. Fannie Mae will finance, such as an investor, they will permit the borrower to finance up to 10 properties. So you can have up to 10 finance properties. Freddie Mac? No. Fannie Mae? Yes. But again, the neat thing, and this is where a lot of folks don't understand, a lot of folks in my business don't understand, a lot of loan officers don't understand. They just take an application, run it through the system, but they never become student of the business. And what they don't understand is Fannie and Freddie are two different entities. They have two different types of missions per se, and Fannie will lend up to that, but you also have lenders that have overlays. And an overlay will basically, Al, say, well, yes, we're going by Fannie Mae or Freddie Mac guidelines, except for A, B, and C. And that might be, we're going to raise the credit score a little. We're not going to, we're going to say, well, 620 qualifies most, but ours is going to be 640. Okay. Well, I know they'll let the debt ratio go up to 45% on this, but we're going to lower it to 41.
So they're actually, is that the trend that the banks are going? They're tightening up a little more than the government would?
Some are, yes, absolutely, because they still have a risk involved with the transaction. They want the transaction to be good. They don't want to have what's called a first payment default, which is the worst thing you can have as a lender.
So back to what I was saying before, but with these investors that have, say, 4 or 5 mortgages on different properties out there, through a Fannie Mae program, they can be considered, and Fannie Mae considers 10 properties.
Up to total of 10 finance properties, including your primary residence. I have an investor right now who's also an agent. He went and got his license too. Terry lives up in Newcastle County, and he's always looking for properties to buy, flip, or however he wants to do it, and he's going to leverage that. So he's going to use the bank's money to buy the property. He's got his own cash, but he doesn't want to tie up all his cash in 1 or 2 properties, so he's going to leverage it. He's going to use that. Well, he's come over to me because his other lenders basically told him about 6 months ago, say, max I can do is 4. Sorry, Terry, see you later. So one thing I do is through Prime Lending, we do up to 10 finance properties, and that's through Fannie Mae specifically. We have an agreement with Fannie Mae to do that.
Well, that's good to know. There's a lot of agents out there that had no idea, and if you're an investor out there, it looks like there is hope out there for you. So most of the loans that I see out there are FHA, Fannie Mae, Freddie Mac, and that's where the government is making the loans. Coming up, we're going to discuss a little bit about the mortgage interest deduction, and we're going to do a little cause and effect session. So we'll be right back.
Testing me, Al, aren't you?
We're going to test you a little bit today, Chris. Thanks.
Hi, Delaware. This is Chris Rowe, and you're listening to Al Escobar on the Delaware Real Estate Show.
Send your questions, your fan mail, and your hate mail to alescobar@gmail.com. We will be reading your letters on upcoming episodes of the Delaware Real Estate Show.